So you want to own a restaurant franchise. Imagine your Wendy's with cars wrapped around the drive-thru, customers filling the dining room, and almost $2 million flowing through the registers in a year. Sounds like a great business. Your logo is famous. Your restaurant is busy. Customers already know what they want before they walk through the door. And almost $2 million in sales sounds like almost $2 million coming to you. Except it is not. It does not even mean most of that money was ever really available for you to keep. Before you pay for the beef, the fries, the employees, the building, the electricity, the insurance, the repairs, or the loan you took out to open the restaurant, the franchise system is already taking its share. Wendy's generally charges franchisees a royalty between 4 and 6% of sales, plus an advertising contribution of roughly 4%, on $1.96 million in annual sales. Those two percentages alone could represent roughly $157,000 to $196,000. And then you still have to operate the restaurant. That is the strange thing about restaurant franchises. Everyone gets paid from your sales. You get paid from what survives. So if almost $2 million can pass through your restaurant without making you rich, what exactly did you buy? Let's say you decide to do it. You want the famous logo. The menu customers already recognize. The drive-thru people already understand. The advertising you do not have to build from zero. So you sign up for the franchise, but you are not buying Wendy's. You are buying the contractual right to operate inside Wendy's system. You receive the brand, the menu, operating procedures, training, technology, marketing infrastructure, supplier relationships, and customer recognition that took somebody else decades to build. In exchange, you pay for entry and agree to follow the rules. Wendy's lists a $50,000 technical assistance fee for each new restaurant, covering a 20-year term. You pay the fee, but the brand is still theirs. The recipes are still part of their system. The operating standards are still theirs. You own the operating business. Think about it less like buying a house, and more like purchasing an extremely expensive license to operate inside a machine somebody else designed. You can use the name. You can use the menu. You can use the procedures. But you cannot wake up tomorrow and decide your Wendy's no longer wants to be a Wendy's. And strangely, that lack of freedom is part of what you are paying for. Because when a customer sees that Wendy's sign, they already have expectations. They expect a familiar burger, a familiar menu, a familiar experience. You did not have to spend 20 years teaching them what your restaurant is. The system did that for you. That consistency has enormous value. Now you have to find out what it costs. You signed the agreement, but you still do not have a restaurant. You have a site and a very expensive shopping list, construction, kitchen, equipment, refrigeration, furniture, signage, technology, inventory, permits, deposits, working capital. The bills have started. Your customers have not. This is the uncomfortable part of restaurant ownership that nobody sees from the drive-thru. Money begins leaving long before money begins arriving. And this is why a major franchise system does not only care whether you can afford the franchise fee. It wants to know whether you can survive everything around it. Wendy's franchise recruitment materials target financially substantial operators with requirements that can reach millions of dollars in liquidity and net worth, depending on the opportunity. That tells you something important. The $50,000 fee is not necessarily the intimidating number. It can be one of the smallest numbers in the entire story. The expensive part is everything required to build the machine behind the logo. Eventually, construction ends. The equipment arrives. Employees are hired. The lights turn on. Your first customer walks through the door. You sell your first burger, and another meter starts running. Now your restaurant is open. Customers arrive. Sales begin, and something interesting happens. The franchise system does not need to wait until the end of the year to discover whether you became rich. Its recurring fees are tied to your sales. Wendy's generally lists royalties between 4 and 6% of sales. Subway lists an 8% royalty plus a 4.5% advertising fee. Your restaurant could be brilliantly managed or badly managed. You could have cheap rent or terrible rent. You could control labor perfectly or spend the entire year fighting overtime. The royalty calculation does not need to solve those problems first. Imagine your restaurant and another franchise across town each generate $1 million in sales. You negotiated a good location. Your competitor overpaid for theirs. You control waste. They throw food away. Your staffing is disciplined. Their payroll is a disaster. From your perspective, These are completely different businesses, but sales-based royalties are calculated from the number at the top. Your profit is your problem. Your sales are the basis on which somebody else gets paid. That does not make the arrangement inherently unfair. You are receiving something valuable in return. The brand may make those sales easier to generate. The system may prevent mistakes you would have made alone. National marketing may send customers through your door before they know your name. But now you can see the asymmetry. You get paid after the restaurant works. The system can get paid because the restaurant sells. Those are not the same thing. Now suppose instead you are looking at Subway. The initial franchise fee in the United States is $15,000. You look at that number and think, this seems surprisingly accessible. But you are looking at the number you pay once. The more important numbers may be the ones you keep paying. Subway lists an 8% royalty and a 4.5% advertising fee, both based on gross sales. Together, that is 12.5%. So imagine your Subway generates $1 million in gross sales this year. 8% is $80,000. Another 4.5% is $45,000. $125,000. And you have not paid for the food yet. You have not paid the employees. You have not paid occupancy costs, utilities, repairs, insurance, or debt. Now imagine, purely as an illustration, that sales stayed exactly the same for 10 years. The simple arithmetic on those two percentages reaches $1.25 million. That does not mean a real Subway franchisee will actually pay that exact amount over a decade. Sales change, contracts change, restaurants perform differently. But now compare the numbers that first caught your attention. $15,000 to enter, potentially far more flowing through recurring percentages over time. The upfront fee is easy to notice because it has a price tag. The percentages are easier to underestimate because they hide inside every sale. The cheapest looking number can be the least important number in the deal. Now your restaurant is operating, and this is where the business stops looking like a logo and starts looking like a kitchen. Every burger requires ingredients. Every order requires packaging. Every shift requires employees. Your location requires utilities, insurance, maintenance, cleaning, technology, repairs, food, expires, equipment breaks, employees quit. A refrigerator does not care that Tuesday was slow. Rent does not disappear because it rained. And your customers do not care that 3 employees called in sick. They still expect their order. Wendy's own company-operated restaurants show how quickly restaurant sales can be absorbed by restaurant costs. In 2025, the company reported that food and paper, labor, and other restaurant operating costs consumed the large majority of sales at its company-operated restaurants. Those are company-operated locations. They are not your hypothetical franchisee profit and loss statement. Your restaurant could perform very differently, but they show you the scale of the machine you are trying to operate. You thought the royalty was expensive. The royalty was never the cost of running the restaurant. It was another cost sitting on top of a business that was already expensive to run. Now it is Friday, 8 o'clock. Cars are stacked through your drive-thru. The dining room is busy. Orders keep appearing on the kitchen screens. From the parking lot, your restaurant looks like a money machine. Then one employee does not show up. Someone else stays late. Your manager jumps onto the line. Orders keep coming. So does payroll. This is one of the strange limitations of restaurant economics. Higher volume is good, but higher volume is not free. A software company can sometimes serve another 1,000 customers without hiring another 1,000 people. Your restaurant cannot produce unlimited burgers with the same kitchen, the same equipment, and the same crew. Every additional customer needs food, packaging, cleaning, kitchen capacity, and human work. Wendy's has cited labor rate, inflation as one of the pressures on its company-operated restaurant margins. And now that pressure is happening inside your restaurant. Too few employees and service collapses. Cars wait longer, orders go out wrong, customers leave. Too many employees, and payroll begins consuming the benefit of the sales you were trying to capture. So every week you play the same game. How many customers will arrive? When will they arrive? How many people do you need standing in the kitchen when they do? Your drive-thru can be completely full, and you can still be watching the margin disappear one labor hour at a time. At this point, you are thinking about burgers, employees, inventory, repairs, and tomorrow's schedule. Now leave your restaurant for a moment. Go upstairs. Not literally. Economically. Look at the same industry from corporate headquarters. McDonald's shows you how different the business can look from there. A local franchisee worries about whether the fryer works. McDonald's worries about the economics of a global network. You sell burgers. McDonald's conventional franchise model can collect royalties and rent. That second part matters, because now the corporation can participate economically in restaurant sales while also receiving rental income associated with conventional franchised restaurants. Think about how different your days are. You're trying to keep enough employees behind the counter. You are trying to keep food costs under control. You are trying to make one location produce a profit. The company above you owns a brand and a system connecting thousands of locations. This does not mean McDonald's is secretly just a real estate company. The restaurants, brand, operating infrastructure, and property economics work together. But it does reveal something important. The business you thought you were buying from the customer's side is not necessarily the same business. The corporation is operating from the other side. You operate one machine. The franchisor owns the system connecting thousands of them. So who would you rather be? Now imagine one of your major ingredient costs suddenly rises. You look at the invoice. You do not like the number. If this were your own independent restaurant, you might find another supplier, change the recipe, reduce the portion, replace the product, or remove it from the menu. But you did not buy an independent restaurant. You bought consistency, and consistency requires rules. Wendy's requires franchisees to use approved suppliers and products that comply with brand specifications for equipment, food, and certain supplies and services. Again, there is a reason for this. Your customer does not want to discover that your Wendy's decided to reinvent Wendy's this week. They are buying predictability. That predictability helped bring them through your door. But now you see the other side. The same system that reduces uncertainty for the customer can reduce flexibility for you. The supplier gets more expensive. The specification remains. The menu remains. The customer expectation remains. And you have to make the economics work inside those boundaries. That is the bargain you made. You received a machine somebody else already designed. You just discovered that owning the operating business does not mean you are allowed to redesign the machine. You have now been operating for a while. So compare your business with the company whose name is above your door. You invested capital into a physical restaurant. You hire the employees. You manage inventory. You deal with equipment failures. You service debt. You execute local operations. You absorb much of the restaurant-level operating risk. The franchisor does something different. It builds and protects the brand, develops products, designs systems, provides training and infrastructure, coordinates marketing, maintains standards, and creates the network that made you want the franchise in the first place. Both sides need each other. Without operators, the system has no restaurants. Without the system, you lose the brand that helped attract customers. But now imagine you have a disappointing year. Your sales are respectable. Your profit is not. Your rent was too high. Labor was difficult. Repairs were worse than expected. Your restaurant generated substantial revenue, but left you with very little. The system can still receive revenue associated with your sales. That is the asymmetry. You need sales to become profit. The franchisor needs the network to keep generating sales and remain valuable. You are playing on the same team, but you are not necessarily playing the same financial game. So maybe one restaurant is the wrong way to think about this. Large franchise systems increasingly talk to operators who want to grow. Subway has sought qualified candidates interested in multi-unit opportunities and portfolios of existing restaurants. Wendy's also promotes multi-unit development. Now imagine you own 5 locations instead of 1. At first, that sounds like 5 times the opportunity. Then Monday morning arrives. 5 restaurants, 5 schedules, 5 kitchens, 5 sets of equipment, 5 places where someone can call in sick, 5 places where a refrigerator can fail. You cannot manage 5 restaurants like 5 separate personal jobs. So you begin building a system of your own managers. Centralized. Hiring. Accounting. Training. Purchasing oversight. Maintenance planning. Now you are no longer simply a restaurant owner. You are building an operating company. That scale can create advantages. Some management and administrative functions can be spread across multiple locations. Your experience from restaurant number 1 may make restaurant number 5 easier to operate. But scale cuts both ways. More restaurants mean more capital, more employees, more leases, more equipment, more debt, and more places where something can go wrong. Now the question is no longer whether one restaurant has a line around the drive-thru. The question is whether the economics can repeat. Because one profitable restaurant is a good restaurant, a repeatable, profitable restaurant can become a business. Now it has been a year. Your restaurant did $2 million in sales. $2 million. You watch that money arrive one burger, one order, and one drive-through customer at a time. Now let's find out how much of it was actually yours. This is an illustration. It is not a Wendy's franchisee profit and loss statement. Start with $2 million flowing through your registers. Suppose roughly 10% goes toward royalty and advertising contributions. $200,000. Now you have $1.8 million. Except you do not really have $1.8 million. You still need food, packaging, employees, occupancy, utilities, insurance, repairs, technology, cleaning, waste, and every other expense required to keep the doors open. Suppose that after the franchise-related payments and all restaurant-level operating costs, your business produces $200,000 before financing and taxes. $2 million came through the registers. $200,000 remains at this stage. Now suppose you borrowed money to build the restaurant. Your annual debt service consumes another $100,000. Now roughly $100,000 remains before taxes. Look at the two numbers next to each other. $2 million in sales, $100,000 remaining. 5 cents from every dollar customers spent. And now comes the number the drive-through line never showed you. Suppose your total investment to open the restaurant was $2.5 million. At $100,000 of annual cash return, the simple payback period is roughly 25 years. 25 years just to receive cumulative cash equal to the amount you originally invested. And even that simple calculation ignores the time value of money. A dollar returned 20 years from now is not economically equal to a dollar you invested today. Again, your real restaurant could perform much better. It could perform much worse. The point is not that every franchise takes 25 years to pay back. The point is what happened to the story. At the beginning of the year, you saw $2 million. Now you followed the money, and almost all of it belonged to someone or something else before it could become yours. That is why revenue is such a seductive number. $2 million sounds like wealth because we imagine the money arriving. Owning the restaurant means watching everything leave. The register measures what customers paid. You live on what remains. By now, you understand your restaurant. You understand the labor, the food, the royalty, the debt, the margins. So you become very good at operating it. And then something changes that has nothing to do with how well you ran. Tuesday night. The brand changes. Customer tastes change. Corporate strategy changes. A promotion changes. The economics of the larger system change. Red Lobster is a useful warning. In 2024, the company filed for Chapter 11 bankruptcy after years of financial pressure. There was no single cause. The company faced high rent, costs, inflation, competition, operational problems, and strategic decisions that made a difficult situation worse. One of the most visible was Ultimate Endless Shrimp. The promotion was made permanent in 2023. It helped increase traffic, but it also contributed to roughly $11 million in losses. One promotion did not bankrupt Red Lobster. The problems were much larger than that, and that is exactly why the example matters. A restaurant does not exist alone. It exists inside decisions about pricing, promotions, brand positioning, supply, real estate, capital, expansion. You can become excellent at operating your part of the machine. You still do not control the entire machine. And that means when you buy a franchise, you are making two bets. One bet is on yourself. Can you operate the restaurant? The other bet is on people you may never meet. Can they keep the larger system valuable? You have influence over the first, much less over the second. The famous logo helped bring customers through your door. Now you understand that the logo also connects your business to decisions you did not make. The thing that gave you a head start can also become a risk you cannot control. Now go back to the beginning. Your Wendy's is busy. Cars are wrapped around the drive-thru. Customers fill the dining room. Almost $2 million flows through the registers. But now you see a completely different picture. You see the royalty, the advertising contribution, the food, the employees, the building, the equipment, the suppliers, the debt, the rules, the risk. So what did you actually buy? Not guaranteed profit, not the brand itself, and not complete control over the business. You bought a head start, a name customers already recognize, a system somebody else already built, training, technology, marketing, supplier relationships, menu development, customer expectations that existed before you opened the doors. Building all of that yourself could take years, and you could still fail. That is the value of the franchise. But you bought the other side of the bargain too. You provide the capital. You operate the location. You hire the employees. You manage the inventory. You deal with the broken refrigerator. You pay the loan. You absorb much of the local operating risk. And after the system gets paid, the employees get paid, the suppliers get paid, the landlord gets paid, the lender gets paid, and the restaurant pays everything required to stay alive. What remains becomes yours. The customer thinks you own a Wendy's. Wendy's knows you operate one. Those sound like the same thing. Economically, they are not. The customer sees the logo, the burgers, the packed dining room, and the line around the drive-thru. You see everything that has to be paid before the money in the register finally becomes your money. That is what a restaurant franchise really gives you. A proven system, a recognized name, and the right to take the remaining risk inside it. The brand gives you a head start. It does not give you the finish line. If you want more breakdowns of the hidden economics behind businesses everyone thinks they understand, subscribe. Because the most important part of a business is often the part customers never see.